Each business is made up of three basic accounting elements: assets, liabilities, and owner's equity. The relationship between these elements is as follows. Assets must equal liabilities plus owner's equity. Let's discuss what each element is. Assets are the items owned by the business that have money value. Assets usually provide a benefit for the business. Examples include, as you'll see here, cash, office supplies, equipment, and accounts receivable. Accounts receivables are amounts owed to a business by its customers. Liabilities are pretty simple. They are amounts owed to others. They are debts or obligations of the business. Examples include accounts payable, or you may sometimes see notes payable, or even salaries payable. If you see the word payable at the end of the account name, chances are that account is most likely a liability. Owner's equity is the next element. It is the difference in the assets and the liabilities of a company. In other words, if the company sold all of its assets, paid off its liabilities, what would be left would belong to the owner. As you'll see, there are four accounts underneath owner's equity. The first is the owner's capital. Capital is the amount invested by the owner into the business. Capital increases owner's equity, as you'll see by the plus sign here. Drawing are assets that are taken away from the business by the owner for his own personal use. As you see, drawing decreases owner's equity. Revenues are amounts that you earn from your customers. So when you perform services, you earn revenues. Revenues increase owner's equity. Expenses are amounts paid out to help earn the revenues. Some examples include rent expense, utility expense, and advertising expense. Notice that expenses decrease owner's equity.